Hello, I'm Bob Peelman, the Director of Wealth Management at the OJM Group. And today we're going to be discussing the election and the market, as we have the election coming up in just a couple weeks, and I know a lot of folks are very interested in hearing how the election may affect the markets, if at all. Before we jump in, it's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. Past performance is not indicative of future results, and some of the information is from other sources that we consider reliable. Also, please review closely the disclaimers at the end of this presentation for more information. One other note before we get started: if you find this information helpful, we would encourage you to check out one of our books. OJM has written multiple books for doctors, business owners, and entrepreneurs, and we have a special offer for you at the end of the presentation where you may download an ebook or a hard copy for free. We'll discuss more at the end of the presentation. So today's presentation, we're going to discuss briefly the upcoming presidential elections, and I've got quite a few slides on the markets, what we've seen in the markets year to date, some of the things that we expect moving forward. We'll do a bit of a market review there, and our outlook for 2017 briefly. We'll be doing more of that in the first quarter, one of our videos in 2017 of exactly in more detail some of our positioning. But I did want to touch on some of our portfolio positioning as we look at the first part of the year after the election. So let's get right to it. I find this chart to be very interesting. The there's quite a few charts on here, so sort of bear with me, the U.S. political perspectives. But this year's presidential race has generated more interest, expressions of concern, questions from clients than any we can remember. Some want to know how the election is going to impact our investment views, how we may adjust our positioning and anticipation, while some have asked how we factor elections into our analysis and our construction of our portfolios more generally. One of the things you'll notice when we look at the top left chart here is right now we are in a very politically polarized time. The chart here goes back to 1901, and what you're seeing here in the blue line is the House of Representatives, and the darker shaded line is the Senate. And this is showing you the percentage of the representative voting with the majority of their party, so sort of towing that party line. And what you can see right now is, going back to the beginning of this chart in 1901, we are at our highest point of a divide, where essentially each party is just voting the party line. Obviously, we all feel that, we understand it, and it's certainly a frustration that we see across the board. And so that really goes into the political climate that, in our view, we have right now. As you look to the chart in the upper right-hand corner, you see the congressional and presidential approval ratings. The presidential approval ratings going back to 1949, fairly average, a little bit below average on the presidential approval rating, but Congress is at an all-time low. And a lot of that is because of what I just showed you on that chart on the upper left-hand corner about essentially not getting anything done, just voting the party line. One of the old sayings in the bottom left-hand corner in politics, I'm paraphrasing, is, if you don't like what's happening in the political environment, just wait a while. And that really holds true. If you see the gray shaded line represents when we've had a Democratic president. And one of the things that happens very quickly is the Democratic percentage of majority party seats typically dips right after that presidency. And what that really says is who's at, and it's not just Democrats. We're illustrating this just one side of the party, one of the parties. The same would be said for Republicans here if you look in the white shaded area. But what we're seeing here is whoever's in party or in power, typically it swings the other way. And typically that's what's made, obviously, the country great, is being able to have that balance and shift of power from one presidential period of time to another. So, and again, the same can be said here with vote swings and election outcomes, the percentage change in votes required for a new party to take control. You can see here the White House, the 2.4 swing it is needed to go Republican, a 2.5 swing to go Democratic in the Senate. And for the House of Representatives, actually, we need about a 7.3% swing to go Democratic. And so this just sort of lays out for you some of the environment that we're in. You know, and one of the things that I think is important is, you know, policy making isn't just about the presidency. Obviously, Trump and Clinton are the big headlines, but the battle for Congress is just as important, and at least one Supreme Court seat will likely be impacted. And these moving parts and the design of government that make it very hard to handicap what actual policy outcomes we could expect. So in our view, ultimately, the opportunities are about fundamentals. Policy decisions could eventually have some effect on opportunities. Healthcare is an obvious example, but policy creation takes a while, and major change isn't guaranteed. So we believe fundamentals ultimately drive investment performance. We saw quite a bit of volatility in the markets in September, and we are prepared for more of that as we head into the election. Elections obviously happen on a regular basis, and investors typically endure these fits of volatility in the run-up as markets are digesting the possible implications. However, we think long-term dislocations are unlikely. But I think there's much more that's being overlooked, which are the really big market drivers. Stories about candidates and policy proposals seem to dominate the media cycle, but they're much bigger influences: government finances, central bank policies, oil prices, currency changes, these Fed rate hikes, which you know, could possibly happen here before year-end in December. And so we've laid out a few of these factors. We think volatility will likely be up, and we don't actually view that as a negative. We think that's an opportunity to rebalance our clients' portfolios, take advantage of some of these inefficiencies, and allows us to help our clients stay on their long-term plan. This is a very interesting chart to me. This shows market declines in historical context. This is going back to 1970 here, and this is simply a dollar invested in large cap company stock index going back to 1970. And one of the things, sort of behavioral finance, that we see with a lot of clients is most investors typically panic when the market starts to decline, and then decide to want to get back in or end up selling after they've already lost considerable value. On the recovery side, they buy in after the initial surge in value has passed, and typically will miss most of the upward momentum. So this graph illustrates that growth of a dollar invested in the U.S. large caps beginning in 1970, and you see four major market declines that have occurred subsequently, including the recent banking and credit crisis. So panic is understandable in times of market turmoil, but investors who typically flee in these moments may end up regretting it. You know, each crisis when it happens certainly feels like the worst one that we're having. In actuality, the one we just experienced with the banking and credit crisis actually was the worst one. But when viewed in isolation on the lower tier graphs, each decline appears disastrous. However, historical data suggests that holding on through these difficult times, whether it be through short-term volatility, is going to generate the type of returns that are going to allow our clients to reach their ultimate goals. So certainly, we're not predicting any type of massive correction depending on the political landscape after November 8th. But even if we were to have a pullback from rate hikes, global policy, central banking policy, or something within the presidential election, again, depending on the age of our client, depending on their time horizon for their goals, many times we view that as more of an opportunity than a hindrance. Just wanted to briefly show a recent sort of market event that we had this past year back in June with the Brexit vote in Britain to exit the European Union. You'll notice on June 24th here on this chart, between June 24th and June 27th, the U.S. stock market, the European stock market, and the emerging market stock market all traded off significantly after the surprise exit of Britain. And one of the things you'll see right after that, post-Brexit, Post-Brexit, the returns subsequently were up 9, 14, and 14.6 after the market had the opportunity to digest that this was more of a news event, and economically the impact, at least at this point, is extremely minimal. And so you can see the returns there over the full period from June 24th now to the end of the quarter of September 30th. So we did not make any changes to the portfolio based on this event. In our assessment, Brexit did not materially impact our long-term 5-year outlook or our assumptions for European corporate earnings growth and valuations. Therefore, we held our positions at the time, and investors, some investors were possibly fleeing for traditional safe haven events, thinking this was going to be the next thing to take the markets or the economy, global economy, over the edge. And that decision proved beneficial for our clients and our clients' portfolios in the third quarter, as European stocks rebounded very nicely, while also from the Brexit vote, while core bonds gained just a mere 0.5% over that same period. So it kind of puts in perspective different types of events in the short term that we might have. Another slide I like to look at is just a quick market review of where we are here year to date. The gray bars are showing each of the main asset classes in the capital markets, along with what we've seen in Q3. Year to date in the bond markets, high yield bonds have continued to perform very, very well. Floating rate bank loans have done well. Investment grade bonds have been fairly strong as well. In the equity markets, we have seen a great year in emerging markets, which has been great for our portfolios, which we've been positioned a little bit overweight in the emerging market space. U.S. small cap and large cap have done well throughout most of the year. A little bit more volatility towards the beginning of the year. If we remember back in January and February, we saw a very large correction with some of the interest rate discussion. The market corrected around 10 to 12%. And then alternative investments, most alternative investments, and I used a couple examples of arbitrage and managed futures. These are there to really dampen volatility and provide a smoother return for clients. And so you can see, obviously, with equity markets running high this year, these strategies have not performed as well. Again, they're there for when the stocks begin to pull back and provide some value to clients. So just briefly on our investment outlook and portfolio positioning, again, at the first part of 2017, we'll do a full presentation on what we view for 2017, but I wanted to give you a little idea of what we're looking at in our asset classes. We view U.S. equities, rising interest rates, as a risk. Profit margins are near record highs and, in our view, unsustainable. And stocks are pricey. Historical outcomes from current valuation levels are not encouraging. And so we also look at the potential rise in interest rates to negatively affect core bond holdings. And so we have shifted to some active absolute return fixed income managers to manage some of that yield and duration for us. And we think that's going to provide a lot of value. We do consider international equities as an opportunity. We still think there's a very attractive stock valuation opportunity with most of the companies and countries within developed Europe. And we view the probability high that market earnings growth will be higher than current depressed levels. And so we have overweighted international equities, and specifically we're looking to possibly add a little bit more to developed international. We've had a strong position in emerging markets for the last couple of years as well. We do view alternatives as an opportunity, and we're always looking to review our alternative exposure. And our goal is to risk-adjusted return potential in up and down markets. And this is going to give us a source of return independent of those traditional stock and bond markets. So that's our high-level view. Again, we'll dive into that a little bit more. Our outlook for the U.S. economy is fairly positive. I think it's good to separate and understand that our view of the U.S. stock market is separate of the overall U.S. economy. We view the economy as a plow horse economy, that 2 to 3% of growth. We have a strengthening labor market, rising wages, improved household balance sheets. Most on the consumer side have more savings and less debt, less consumer debt than we've had in decades. we have a higher level of consumer confidence than we've had in a while. Inflation is not a massive issue, and energy prices have been continued to be depressed. So the U.S. economy, in our view, is going to continue to chug on, and that's going to ultimately be positive for not just the U.S., but globally, what our view is. So from a moderate economic recovery, our base case, our macro view and assessment of the risks and returns across the major asset classes has not changed meaningfully since last quarter. Our base scenario, we continue to see the U.S. economy and the global economy will more broadly, on a slow path of recovery, continue to grow from the '08 crisis. And you can see some of our bull and bear cases there as well. So I wanted to frame for you today in this conversation a little bit about what we're hearing within the political landscape of the volatility that we do expect, but we view it more as an opportunity, and certainly that's what we express to our clients and how we think we can take advantage of the volatility. And we don't view, and certainly things can change, but we don't view right now in the short term meaningful policy change that would affect one of the asset classes that we're currently a part of. So I want to talk a little bit. Today I covered the specific topic of within our wealth management division, how we're managing assets based on the election, the markets. But we at OJM have expertise in a number of areas: asset protection, tax reduction, corporate structure, benefit planning, retirement planning, insurance. And so I'd like to give the full scope of what we do on the comprehensive side for our clients and offer our services. OJM specializes in working with our clients for the last 20+ years. In fact, we've worked with over 1,000 clients throughout the country, upwards of 48 states. I just showed on the previous slide our multidisciplinary approach to managing our clients' wealth, not only from an investment standpoint, but from a protection and insurance standpoint, as well as asset protection and saving and reducing taxes the best that we can. We can also help both on the personal and corporate side for the business owners out there and provide guidance on both aspects for our clients. I want to talk a little bit about our team here at OJM, our wealth management team. I'm the Director of Wealth Management here within the Investment Advisory Division of OJM. We also have two other wealth advisors, Andrew Taylor and Adam Bronscheitel, who are working with clients day in and day out, managing portfolios, and support staff as well, Kristen Courtney on the team to help our clients with some of their day-to-day transactional needs. So next steps, you can receive a free copy of For Doctors Only or Fortune Building for Business Owners and Entrepreneurs, or one of our other books referenced earlier in the presentation. To receive your free copy of our book via ebook for Kindle or iPad, you can visit www.ojmbookstore.com and use the promotional code WEB1016 at checkout. Hope you check out one of our books. We're always open to a free consultation. We'd love to talk with prospective clients about our views, how we work, what we do here at OJM. And so you'll see our contact information there at OJM Wealth Management Team, 877-656-4362. So enjoy the free copies of our books, and we hope we have the opportunity to speak with you soon. Thanks for watching.